This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant content in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
I'm Paul Sweeney. Alix Steele is out this week. On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets. Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide. Today, we look at why London employers are more open to remote work than their peers. Plus, can Amazon keep growing? But first, regulatory changes in the U.S. and Europe could fundamentally change global markets in 2024. For more, we're joined by Bloomberg Intelligence Head of Market Structure Research, Larry Tabb. Larry, thanks so much for joining us here. Talk to us about some of the changes that we may see in 2024 as it relates to some of the big securities exchanges around the world.
Hey, Paul. Thanks. Great to be here. A lot of regulatory change up in the air, and actually Europe and the U.S. are going in different directions. The U.S., for folks that haven't been following it, the SEC has been very active at making many proposals to change the U.S. equity market structure. They want to bring retail order flow back into the fold. That said, there are a lot of people, not unlike me, who don't think the SEC is moving in the right direction on that. They want to provide greater transparency, which I think everybody's in favor of. They're looking to reduce the spreads for stocks, and to a certain extent that's a good thing, but the SEC wants to take it a little far, down to tenths and fifths of a cent.
Wow.
They want to layer on some new best execution rules, and depending upon how they're done, that may be a good thing. And then last, they want to create retail auctions, basically auction off every single retail order. And theoretically, that's good, but the way that they've kind of proposed that is a bit onerous and may actually wind up with unintended consequences, basically worse execution for retail orders. And then there's another proposal out there called the Predictive Data Analytics tool, which may have a really significant negative implication for U.S. retail investors, that it almost pretty much precludes any broker from putting out any type of content that may cause a retail investor to make a trade, and may force them to pull a lot of that content off their website. So a lot of things going on to much more thoroughly regulate the U.S. equity market structure.
Here in the U.S., it seems like, more and more retail investors are trading. It's free, basically, on every platform. So reducing that friction, is the SEC concerned that it's become too democratized and that there's not enough guardrails on the exchanges?
I think that's what they're worried about. They're thinking that there's actually too little friction, that folks are just trading basically because the retail brokers are giving them information to trade. And to a certain extent, they feel that every time they trade, they're actually losing money. So the SEC seems to want to be saying that, hey, look, we want retail investors to trade less. We want them to buy things and hold them, and we think that's better for the U.S. investor. On the other hand, if you're open, if you believe that folks can invest money the way that they see fit, and you think people are generally smart with their money, these rules may be contrary to those issues.
It's these exchanges just in general have become real technology powerhouses. Talk to us about AI and just technology in the exchange business and the market structure business.
We're starting to see some AI filter into some of the exchanges and some of the alternative platforms. Some platforms like IEX use AI to try to move client orders out of the way if they see the market moving. The exchanges are kind of moving into the data side and the technology side, as well as, to a certain extent, the options market is booming. While we saw equity volumes kind of top out during the meme stock craze in the early 2021s, options volume continues to grow, and they're shortening the duration of options. They're creating more biweekly expirations, which are causing a lot of volume, which is really interesting and good for that marketplace.
Our thanks to Bloomberg Intelligence Head of Market Structure Research, Larry Tabb. Let's turn now to the post-pandemic workplace, where differing economic conditions are making London employers more open to work from home than their Paris peers. For more, we're joined by Bloomberg Intelligence senior real estate analyst Sue Munden. So here in New York, I would say most companies kind of 3 days a week, maybe 4. What's it like over in London and Paris?
Yeah, absolutely. It's very similar here, actually. We've just run a survey in London and Paris at the end of November, asking sort of 2 lots of questions, really. The first is really what's happening with work from home and what the practices are, what they'd like, and how important it is to them. And then we've also done a section of questions sort of asking what is their employer doing about the space to cater for this. And yeah, as you said, most of the employees have got 2 to 3 days working from home, so that's about 60% or so in London and 50% in Paris. But I think what was really interesting is that in London, only 4% of our respondents have to come into the office 5 days a week, whereas in Paris, in Paris the number was 20%. So where they're different, the 2 cities, is that in London, actually 16% are fully remote of our respondents, and it was only 7% in Paris. So there is a difference to this. But what was also interesting is that when we said to them, what would you like to do? Actually, in London, it was pretty aligned with what's actually happening. So it was that same number, 4% would be happy to come in every day, whereas in Paris it was 10%.
Boy, I feel special now that I come in every day in New York, not by choice, but that's the way it is. So when you talk to real estate owners, what are they saying about the need for office space? I mean, if it's got to be less over time.
Some of the REITs have actually done their own surveys on this, and they talk about their own clients. And there is obviously a slightly different story that they're telling us than what we're seeing from our respondents. But our respondents are saying that there are sort of 2 key themes that are coming through so that they can cater for this. Because quite a lot of the leases, the legacy leases are long. In London, you typically have signed as an employer a 10 to 15-year lease, and in Paris it's more like 9 years, but with a 3-year break. So there's a bit more flexibility, and I think that comes through in a bit in the numbers. So what they're doing is they're hot desking, and again the numbers are quite large. It's over 50% of our respondents were hot desking, and by that I mean that they have to sort of book their desk when they come into work every day. And sometimes it's a sort of quite organized system, but most of the time it's just a first come, first served.
Right.
So that's one way of really leveraging the space, because obviously you can increase your staff level but not increase your desk, so you just keep the same space that you've got. The other thing that's happening is that when those leases end, because they're not quite sure of how much space they're going to need, a lot of the companies are opting for what we call co-working or flex space. And this typically has like a 2-year lease, maybe a 3-year lease, or even shorter. And it's maybe fully fitted out already and fully managed. And this really resonates with what the REITs are saying. One of them, Great Portland Estates, has said that they want to convert 40% of their office portfolio in central London into this kind of space. And they want to do that because they gave us the numbers for what they managed to get back from it in terms of returns. So they're making double the rent on these kind of leases, and from a cash profit basis, because obviously they're more costs, they're still getting 76% more. So, it's quite profitable for them, and we're seeing all the REITs sort of dedicating some space either to their own brand of this sort of co-working or getting in third parties to do that for them and giving them some space, because there's several, not the WeWorks too much, although there have been some cases of WeWorks being tenants in London, but that's what's happening there.
What's the commuting issue for a lot of workers in Paris and London? Is that a big issue as it is here in the greater New York area?
Yeah, it is quite big. I mean, in London, the average commute, well, we gave some bands of time. It's sort of anywhere between half an hour and 90 minutes. And typically, if you're even living in London, your commute is about 45 minutes to an hour. And then obviously there's a lot of people who live outside London. And in Paris, there, I think one of the main problems is that the lines are really prone to strikes. I mean, we've had our fair few strikes in London over the last year as well, but strikes is quite a big thing. And in London as well, the cost of commuting, it's much more expensive. And in Paris, the employers pay for some of their commute costs, which sounds really nice. I didn't know about that, but they do.
Yeah.
But in London, you pay your own commute costs, and so that's quite a deterrent for coming into the office. But then the flip side of that is they don't have to pay so much in the way of heating bills, so they come to office. So there are a few things either side, but commuting was a big one on both sides.
All right. Our thanks to Bloomberg Intelligence senior real estate analyst Sue Munden. Coming up on the program, we'll get the latest on Amazon's legal woes. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or listen on demand wherever you get your podcasts.
Amazon is facing lawsuits on several fronts, but the company could come out unscathed. For more, we're joined by Bloomberg Intelligence litigation analysts Jennifer Rhee and Matt Sheltonhelm. Jen, let's start with you. Is it possible for Amazon to ever buy anything again?
Well, let's just say it will be very difficult for them. Certainly it's possible for them to buy another company at some point. It'll obviously depend on the company. And depend on the administration that's in power at the time that they do it. But right now, at least, Amazon should expect to get pretty significant scrutiny, as they try to grow and stretch into other industries and areas.
I mean, they're just so big, first on the e-commerce side and now on the cloud side. Is there any credible talk of maybe at some point breaking up this company, splitting in two?
Well, so there's actually, already an effort by the Federal Trade Commission, not on the cloud side, but on the e-commerce side to actually break up the company. I mean, they do have a lawsuit. They haven't talked much about remedy. They haven't been clear about the remedy, but I think we all know that one remedy they'll put on the table if they're successful on liability is a structural breakup of the company. And this is focused on the marketplace. This is allegations that Amazon maintains its monopoly power as what they call an online superstore market and an online marketplace services market by engaging in conduct that increases prices, such as anti-discounting, punishing third-party sellers that offer a lower price outside of Amazon.com, or by tying Amazon Prime eligibility for third-party sellers to also buying Amazon's fulfillment services. So that's ongoing. And I think the FTC would, if they're successful in that suit, try to seek some sort of a structural change.
So, Matt, it's not just antitrust issues. There's other legal issues that any large company would have. What are some of the key litigation risks out there for Amazon?
Yeah, that's right, Paul. And I think really piggybacking on where Jen was in talking about the Federal Trade Commission, I think one of the most significant pieces of litigation that Amazon's dealing with right now is a lawsuit that Lina Khan's FTC filed against Amazon this summer, again focused on Amazon's Prime service. And here the allegation is that basically Amazon dupes its consumers into sticking with or subscribing to Prime and then making it very difficult for them to cancel. And the FTC brings this lawsuit under a 2010 law that lets it obtain pretty significant damages per subscriber. And when you have 100 million Amazon Prime subscribers, you as a company have to take that threat pretty seriously. And so, you can get to, significant damages numbers when you do that math. That said, I think Amazon has a really strong argument that it's presented so far in a motion to dismiss that's teed up now that really the FTC under Lina Khan is really stretching the limits of this law. The law only requires a simple cancellation process. It doesn't really say what is simple. and Amazon says, look, this requires a couple clicks to get out, to cancel your subscription, that's certainly enough to honor the law in the company's view. In my view, I think the company can avoid this sort of litigation.
I mean, haven't they ever tried to get out of a cable bill or, a cable service or a phone service? I mean, that is brutal. These, I don't know, it just seems like Amazon, everybody loves Prime, it seems like. So is there anybody out there, Matt, is there a class of people out there that are saying Amazon Prime, this Prime business is not kosher?
Yeah, so there really isn't. That's the striking thing about this is it's a pretty popular service, and the FTC pushing the limits of the law really is questionable. Where Amazon is facing a class action, though, that could be significant is in Illinois, and this is a case that Amazon's reported in its 10-Qs as a potential material risk. Illinois has one of the most significant biometric privacy statutes on the books across the country. It's been a problem for a number of companies. Facebook ended up settling a case for $650 million a couple of years back. Amazon now is facing litigation, in particular tied to its Alexa voice app. And the allegation there...
Another great product.
Another good product that people like, but the litigators smell blood in the water and see a statute that lets them collect significant damages per user, and they see a company with so many users, and so the allegation here is that Amazon's collecting your voice print without obtaining proper written consent, as the Illinois law requires. And so far, that class actually made it past Amazon's motion to dismiss a couple months ago, but the court said just barely, and so the judge let it get by that initial hurdle. Again, I think this is a case that Amazon can win, and even if it can't stop it before it gets to trial, probably not looking at a settlement in the billions, probably a settlement in the hundred millions of dollars, worst case.
Hey, Jen, Amazon is such a huge company. They're in so many businesses, and they're really just, they touch so many consumers out there. What is their Washington, D.C. legal / I don't know, what's their presence in D.C. to make sure that their arguments get heard?
You mean you're talking about the Federal Trade Commission?
I would think they would have a big lobbying effort, Amazon, and it's just because they interact with so many government agencies.
Oh, absolutely. Look, back in 2022, Amazon faced a serious threat of some legislation that would have banned self-preferencing type conduct. So, in other words, if Amazon sells its own product on its marketplace, it can't give preference to that product over a competing third-party product that's also on the marketplace. And there was just massive lobbying by Amazon as well as some of the other big tech platforms. And, who knows what exactly helped to stall that legislation. It did stall. It advanced somewhat, and then it kind of went nowhere, and now I think things are pretty quiet with respect to at least that particular bill. It's still out there. I haven't heard very much about it, but certainly what contributes to the inability to get certain House members and senators to vote yes on these bills are these lobbying efforts by companies like Amazon. So it's absolutely out there fighting for its own cause.
So what do you think, Jen, just from the antitrust perspective, what do you think is kind of the biggest risk for Amazon, over the next several years?
Well, look, right now it's this FTC case. It's a serious case. Amazon has had these sort of smaller consumer class actions it's been fighting for a while that are kind of hanging on. They're getting past motions to dismiss. I'm not so sure I see these cases as having a lot of success or impact down the road. They would likely just settle. So you've got this FTC case. The FTC is not going to settle. This is the goal of the chairperson, Lena Khan, has been for many years to go after Amazon. She sort of rose to fame by writing a book about what an illegal monopolist Amazon is. I see the risk to Amazon, to be honest, from an antitrust perspective, as lower than it is for some of the other big tech platforms that are also under fire right now. And it's because exactly what you said, Paul, while you were talking to Matt, that the products are well liked by consumers. There are a lot of pro-competitive aspects to what Amazon is doing, and it is really hard to go into court and to convince a judge to do something that might kill that.
Yeah, it's interesting. Not a lot of consumer, complaining per se about Amazon and its conduct. All right, guys, great stuff. Thanks very much for joining us. Bloomberg Intelligence Senior Antitrust Analyst Jennifer Rhee and Litigation Analyst Matthew Schuttenhelm. Coming up on the program, more on Amazon, how the e-commerce giant could get even bigger. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program Saturdays at noon Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts, covering some 2,000 companies and 130 industries worldwide. Amazon is one of the biggest companies in the world, and it's not done growing yet, even in the face of regulatory concerns. For more, we're pleased to welcome Bloomberg Senior Technology Analyst Anurag Rana. Anurag, the cloud, we know that's become the number one story for the Amazon stock. What's your take on where AWS is these days?
So Amazon, when we look at, with AWS right now, we are running somewhere around $90 billion of run rate for Amazon. That's where they'll most likely end by the end of this year. And the question we get most, Paul, is, how big is this market? How big can Amazon get? Because, frankly speaking, when you look at technology company, $90 billion is a lot of revenue. But our big argument is when we look at the entire technology spending area, which is somewhere north of $2 trillion and growing, $90 billion is a very small number. And frankly, Amazon Web Services provides something that to us is a utility. It's not something that's very fancy. It's not it's not Word, it's not Excel, but it's something that's nuts and bolts that you use to create an application. And with that framework, I think there is a lot more runway for Amazon to grow over the next several years. We think it's, there is no reason why this shouldn't be a $200 billion business over the next, let's say 5-6 years, depending on, what your appetite for growth rate, frankly. But that's really our big call is discussion around Amazon Web Services.
Talk to us about, it's been such a great story for them, but it's also been a great story for Google and Microsoft and others. Give us a lay of the land in terms of the competition.
When we look at cloud in total, there are two separate elements that we focus on. One is the applications and one is infrastructure. So when cloud really got formed, you have to go back to somewhere around 1999 when Salesforce was formed around that time. Applications were so much easier to be hosted because all you're doing is somebody like a Salesforce is creating an application like a Facebook, actually, where all you need is a username and a password to log into that and do whatever you need to do. You don't need to install it on your computer. That movement towards applications moving to the cloud probably had, in my view, a 10-year advantage over an infrastructure piece where you really don't need to buy the actual hardware. You don't need to buy servers. You don't need to buy storage devices. All you need to do is log into Amazon servers and start coding over there. So when we look at the cloud market today, it's disproportionately shifted towards applications. That is companies like Salesforce, Workday, and my Office 365, for example. But then when you shift towards infrastructure, you have, frankly, three big companies. That's Amazon Web Services with a very high market share. Then you have Microsoft Azure, and then you have Google Cloud Platform.
So it's just amazing. The top line growth has been there, and it's really been a profitable business. And Amazon shareholders historically have not enjoyed a lot of profits because that e-commerce business is a very low margin business. But talk to us about the profit profile of the cloud business for Amazon.
Yeah, this is really the crown jewel for Amazon, which is one of the reasons we don't think it'll ever be spun off, and that's part of one of the big theses. And really, I think the Amazon story did turn around several years ago when they first disclosed how much profit they can generate. At this point, we are running somewhere around 25 to 30% margin business, but frankly, we think this business has a potential to reach 40%, and I think that's where we differentiate compared to a lot of our peers on the sell side, because when we look at a business model like a MasterCard or a Visa, when you have a very large footprint of a fixed cost business like Amazon Web Services, and you don't need to expand as much, which probably will happen in 6 to 7 years when growth slows down, then it becomes truly a question of what falls to the bottom line. We have seen those businesses of operating margins north of 50%. You have exchanges that have very high operating margins. We see no reason why AWS is not going to hit 40% one day. It's already actually gone above 30 a few times. This is despite massive amount of investments that are currently going in. So when you look at a company like Amazon Web Services, several years out, we can think of a business that's over $200 billion in business with 40% operating margins.
Just extraordinary. I mean, so what's the risk to this story? Is it a competitive risk? Is it a new technology coming along? It just seems like this is just incredible.
Yeah, so Paul, the thing is, the way we think about, again, as I said, think of this as more as a CapEx business that has really deep entrenchment. Now, I think there is going to be a lot more disruptions in the application space than in the infrastructure space, because there could be somebody out there writing really good code that can disrupt what Salesforce is selling or what Workday is selling. But when you look at something like an Amazon or a Microsoft Azure, you're requiring, these guys are spending $35 billion a year to create those data centers. You just can't do that in your garage, or you really can't have technology take up the fact that you have to hire so much in terms of engineering talent, as well as buy servers and real estate, etc. So there is a moat there that is in the form of the CapEx that's going in. So when it comes to that business, I think the big risk, honestly, is regulation. Yep. And if the regulators go out and treat this AWS and Microsoft Azure as a utility and start looking at pricing and other things, that's, I think, the big risk for the company.
So where are we with that? I was just going to raise that as a risk, regulatory risk, because whenever you see these technology companies get big in a business, whether it's search or whether it's even software, going back to Microsoft days, the regulators start looking. Where are we with the regulatory environment here?
There's a lot more pressure to basically showcase that Amazon Web Services is a dominant player and they can use their influence. But frankly, in our view, what's happening right now is they're actually the lowest cost provider. They're truly disrupting, somebody's total cost of ownership. So I think it's a very silly argument to make that if I bring it in-house, I'm actually going to pay more. So as long as they are not going to start this price gouging or anything, I think Amazon Web Services, or for that matter, all the other cloud providers should be okay, because they are, we're not seeing any price increases at this point. In fact, prices have been going down for basic cloud services for many years.
All right, Anurag, great stuff as always. Appreciate it. Our thanks to Bloomberg Senior Technology Analyst Anurag Rana. For more on what's going on inside the company from the retail perspective, let's welcome Bloomberg Intelligence Senior Retail Analyst Poonam Goyal. So Poonam, this story has evolved from the traditional e-commerce business now into a tech story driven in large part by their web services, Amazon Web Services, but they're still a retail behemoth. Talk to us about the drivers for Amazon.com, the retail business going into 2024.
Sure, Paul. Yeah, Amazon is still a very sizable retail business and only getting bigger. In fact, when we do the math, we're seeing them getting to $1 trillion in GMV in 2026. And that's on top of over $600 billion that they achieved based on our estimate in 2022. So what's driving that growth? It's really twofold. And the largest piece of that growth is coming from their third-party merchants, which control more than half of their GMV already today and approaching 70% based on our estimates. It's as more merchants take advantage of the shift to digital, we're going to see more merchants come on to sell on Amazon, which is really what's driving this 3P business. And we think that'll continue to be the driving force for Amazon as we move into the next 5 years.
If you're a third party, what's the real advantage to going to Amazon? It's just simply they're so big?
Well, there's two advantages. One, Amazon reaches 200 million people across the globe, and that's a big number. The second is if you are selling on Amazon, it's likely many are using Amazon's fulfillment and logistics network. And through that, they can guarantee 2-day, same-day free shipping to Amazon Prime members. So really, it's twofold. The shipping, the storage, right? You don't have to do anything yourself. You can send your stuff in. Amazon will sell it. Amazon will take care of everything. And you just collect your revenues and give them the 30% take rate, which is what we calculate they take.
Yeah. And so give us a sense of just the market. I mean, during the pandemic, it seemed like everybody really accelerated their e-commerce activity here, spending a lot more time buying stuff online rather than going to the store. Just give us a sense of how that trend developed over the last several years.
Sure. So if you were looking at prior to the pandemic, many would argue that e-commerce sales as a percent of total retail sales were maybe 10-12%. Fast forward to the pandemic, it became 25% of retail sales. So today where we sit, 25% of everything that we buy in the U.S. in the retail front is e-commerce. And it doesn't stop there. We're estimating that can go to 33% of total retail sales in the next 5 years. And the growth that you're going to see, it's about $1 trillion will be added. And that growth, the bulk of it is coming from digitally native retailers, of which Amazon controls a large piece of.
Interesting. So how about growth? Talk to us about the global reach of Amazon. Where do they get their revenue and where are some growth areas geographically?
Sure. So the bulk of Amazon's GMV still comes from the U.S., but that said, they do have growth opportunities internationally. The market that comes to mind with potential growth is India. It's clearly got the population to support growth, but it's not going to be an easy battle for them to be dominant there because India does lack infrastructure, and there are local competitors and also international ones like Walmart that are really also stepping up their game. But we do see it as an opportunity. In Europe, they do have scale. They are the largest, but I would consider Europe a more mature market relative to India.
And competition, I mean, it seems like everybody's got a website. Everybody got really smart on e-commerce over the last 4, 5, 6 years, if they were ever lagging behind. But talk to us like Walmart and some of the other competitors out there for Amazon.
Yeah, I think Walmart is definitely stepping up its game on the e-commerce front, so there is competition there. But if you think about just the other e-commerce companies, while everyone may have an e-commerce site or maybe fueling one through Shopify, what Amazon really differentiates itself in is its distribution arm. The fact that you can get something the same day or in 2 days or less for free, and the fact that you can access millions of items on one platform, it's incredible. I mean, when I think about going shopping, Amazon has become my Google search engine, right? Where you kind of go in and say, I want this, and you can almost find it on Amazon. So it's that differentiates it versus other digitally native peers or even the brick and mortars that have expanded into the digital realm.
Where are we on kind of the last mile delivery? I mean, I remember hearing something about drones at some point, but where are we on that last mile?
I think electric vehicles is probably more what we're going to hear them use to help with the margin front and just on their ESG front. But on drones, it's still in test, just like with many other things that Amazon does. It's an idea out there. Should it and when it scales, it could help. But right now, I think the focus is really how do they maximize their last mile delivery. And what they've done to really do that is their distribution hubs. They've basically scattered them. Instead of having just central regions, they now have a handful of distribution hubs where they carry all types of inventory so that they can get the top-selling items into any market within the same day. That's the goal. They're trying to push for same-day delivery, and this realignment of their distribution hubs is going to help them get there.
All right. We know that the bulk of the profits at Amazon come from the cloud. Talk to us about the profitability of the e-commerce business and kind of what are the levers there?
Sure. I think this is where the story gets interesting, Paul. When we think about Amazon on the retail side has been losing money for as long as I can remember. Came AWS, it generated the bulk of their profit. But as I fast forward into the next few years, the advertising business is what makes retail interesting. That business that's growing that's at a $50 billion run rate. If you think about the profitability of that business itself, it carries even higher profit margins than AWS. So when you see profit margins of 50 to 70% on that business, that's flowing directly to the bottom line. And that's what makes retail profitable. And I think that's the story from here onwards for the retail profitability aspect.
Didn't they get into the grocery business?
They're still in the grocery business.
All right. What are they doing in the grocery business? Because, everybody freaked out like they typically do when Amazon comes into your business. They haven't really done much, have they?
They haven't. So, they're trying to scale Amazon Fresh. They have Whole Foods, but they haven't moved the needle. If you look at the grocery business overall, Amazon controls just 1% of that. And we think it's a hard battle for them to win. They really have to do a lot more. They recently just announced that they're reintroducing the free delivery if you pay $9.99 a month. That's new. They're testing it in 3 cities. As they scale that, I think they could maybe push rivals to make adjustments to their own strategy. But I do think that grocery is not an easy win for them, and it's not part of our thesis for them to really get to that $1 trillion mark.
Yeah, there's a lot of levers to pull there, that's for sure. Our thanks to Bloomberg Intelligence senior retail analyst Poonam Goyal. That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. And remember, you can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.